A risk is a possibility of a loss. An investment risk, therefore, is the possibility of you losing the value of your assets, a portion of your investment, or all your investment altogether. And this is not something that any of us would like to experience. So in this video, or in today's episode, I am going to be taking you through the different types of investment risk that you need to be cautious about as you make your investment or as you make your journey towards attaining financial freedom. And because I'm going to give you a long list of these risks, I'll put in the description box timestamps so that you can feel free to scroll through to the specific risk that might interest you. First on our list is liquidity risk. What is liquidity risk? Liquidity is the ability for you to convert your asset into cash. So liquidity risk is the risk that you might not be able to convert that specific asset that you are holding into cash when you'll be needing the cash. It's also the possibility or the risk of you losing the value of your investment in the process of you converting it to cash. Which are some of the assets that will predispose you to liquidity risk, or which assets carries liquidity risk to them? Number one, property. Property. There is a possibility that when you hold a landed property, a landed asset, or an asset in property, when you need cash, when you are in need, for instance, you have an emergency and you need cash, you'll go to the market trying to sell that property, and there's a possibility that you'll not find a buyer for that property when you need the money. There's also a possibility that sometimes you might have to sell it at a lower price than the market value so that you can close on that sale. So property is one of the assets that will predispose you to liquidity risk. Another asset that will predispose you to liquidity risk is shares, investment in stocks. How? When you buy a stock at a specific price, $100 or 100 shillings, and you need money. And at the time when you need the money, when you want to dispose these stocks, there is a reduction in the share prices. So when you sell it at that reduced price, you are going to make a capital loss. A capital loss is the loss that you incur when you sell an asset at a lower price than the price that you bought it at. So that means that there's a liquidity risk. Why? Because there's a risk that when you need the money and you go to the market to sell that stock, the prices will be low. So there's a risk of you losing a value of your investment. Even bonds have liquidity risk. Why? You bought a bond when the coupon rate was at 10%, and now the market rate is at 18%. Tell me, which investor will want to buy your bond, which will pay coupons at 10% at a time when this investor has a chance to buy a bond with a coupon rate of 18%? You are going to be predisposed to a liquidity risk. Why? You'll have to sell this low coupon bond at a discount. And when you sell it at a discount, you, the investor, will be making a capital loss. So even bonds also carries with them liquidity risk. Remember I told you a risk is the possibility of you losing even a portion of your investments. Which assets will predispose you to liquidity risk? Leave me a comment in the comment section as we go through on to the next risk. Now, the next risk on my list is credit risk. Credit risk is a risk that your creditors will fail to pay you. The risk that you lend somebody money and that person fails to pay you. Most banks have credit risk. In fact, they have a credit department because they're in the business of lending people money. So they face the risk that the people they have lent money will fail to pay them back. Another credit risk you are a business person and you sell in credit. What are the chances that this customer whom you've sold for in credit will fail to pay you? Credit risk, the risk that your creditors will fail to pay you. We also have default risk, which is closely linked to credit risk. Default risk is the risk that your creditors will default in payment. This is including your tenants if you are a landlord. You've heard about the government is at risk of defaulting. Yes, when you invest in treasury bonds, you absorb or you take in the credit risk, the risk that the government is likely to default. I had told you before that no investment is risk-free. So default risk and credit risk are closely interrelated. Another risk that we have is inflation risk. What is inflation risk? Inflation risk is the risk of your money or of your asset losing value. For instance, you invest in a SACCO. Over the past 20 years, you have been contributing a specific amount to the SACCO. If your money has grown to 10 million or 100 million, and every year you earn dividends or interest, and you use these dividends. Why? Because at the back of your mind, you know that you'll be having your 10 million or your 100 million, right? That investment or that savings that you make in your SACCO exposes you to inflation risk. Why? Because at the end of at your retirement or by the time you'll be exiting the SACCO, you'll receive back exactly the savings you have been making to the SACCO, of course less the loans. So by the time you'll be receiving that money at the end or at the point of your exit of the SACCO, that money would have lost value to inflation. Another asset that is bound to lose money in inflation or that is exposed to inflation risk is investments in treasury bonds, especially the long-term treasury bonds. You invest 100 million now for 30 years, and every 6 months you receive coupons, but at the end of the 30 years, you'll receive back exactly 100 million. Now, whatever 100 million will do to you now, or whatever assets you'll acquire using the 100 million, is not what you'll acquire using the 100 million 30 years from now. The purchasing power of that 100 million would have been lost. So treasury bonds will also predispose you to inflation risk. Another risk that we have is interest rate risk. What is interest rate risk? Interest rate risk is the risk of interest rate fluctuations. And which kind of assets exposes you to interest rate risk? Your investment in money market funds. Why? Because their interest is not fixed. They invest in treasury bills, they invest in commercial papers, they invest in bank deposits, and they pay you interest at the end of the month. And these interests vary month on month. So investment in money market funds predisposes you to interest rate risk. Another investment that predisposes you to interest rate risk is even these fixed income investments like bonds. Can you picture a scenario where you took up an investment in a treasury bond at a coupon rate of 8%, and now the rates are at 17%, while others are investing and earning interest or earning coupons at 18%, you are continuing to earn coupons at 8%. You'll have been exposed to interest rate risk. Why? Because you have lost, quote unquote, value in the interest that you'll have been earning in this bond had it been adjusted, had the coupon rate been adjusted to match the prevailing market rates. So fluctuating assets would predispose you, like SACCOs and MMFs would predispose you to interest rate risk. Fixed assets also would predispose you to interest rate risk. That brings me on to the next risk, reinvestment risk. What is reinvestment risk? The risk that when you are reinvesting your asset, you will lose value. And one of such assets that predisposes us to reinvestment risk is treasury bills. I want you to picture a scenario where you took, the rates were at 18% like they were last year or early this year, and then instead of taking the treasury bonds that will lock the interest rate for the entire 18 years or 5 years or 8 years, for a longer duration of time rather, you picked a treasury bill. 1 year down the line, the interest rates have dropped to 10%. Those who invested in treasury bonds at 18% continue to earn their coupons at 18%. But you invested in a treasury bond and you earn your interest at 18%. And now at the point when your treasury bill, is maturing, the interest rates are at 10%. At what rate are you going to reinvest this investment? You'll reinvest at 10%. So that risk that at the point of you or at the point of your asset maturing and you're going to reinvest it, the rates will have come down, is what is called reinvestment risk. The risk of you losing value in your assets at the point of you reinvesting. Another risk that you need to be cautious of as you invest or towards a journey to attaining financial freedom is market risk. Market risk is the risk of market dynamics or market becoming unfavorable for you. The risk of your assets being affected by market forces, demand and supply. For instance, you are a farmer. Let me tell you one story. Once I farmed tomatoes. At the point when I was farming these tomatoes, the prices were at 7,000 shillings per a box. By the time I was harvesting, the prices were at 1,000 shillings, market prices. What happened? I was exposed to market risk. The prices were down. There was an oversupply of tomatoes at the time when I was harvesting my tomatoes. And so I was exposed to market risk. However, had I mitigated that risk pretty well and found my tomatoes and matched my harvest time to a time when there will be an undersupply of tomatoes, I would have made a kill. I would have made huge profits. But I was predisposed to market risk. Market risk is the risk of market forces. Forces beyond your control, affecting the value of your assets. You are an investor in property and you go into this section. You acquire a property in a specific area and you build up your apartments. And then other people, the people around you, the market around you, decides to bring up slums. Do you think that your assets, the apartments that you had put up, will still carry the same value? Of course, the upcoming of the slums around this property, which is something that you have no control about, will affect the value of your investment. Another risk that we have is a longevity risk. The risk of you outgrowing your assets. For instance, you are employed and you are a member of a pension fund scheme. At the end of your retirement or at the point of your retirement, your pension fund pays you your money in lump sum. And you use these monies for your first few years in retirement and then it runs out. You'll have been predisposed to longevity, the risk that you have outlived your investment. Which other asset do you think you can outlive? Or which other investment do you think you can outlive? Please leave me a comment in the comment section. Pronouncing that word is so difficult. Another risk is political risk Political risk is the risk of changes in political environment affecting the value of your assets. For instance, you run a school, and we have and the government decides to implement regulations that will affect the operations of your school. Publishers, remember when we had a change from 844 system to CBC system? We had publishers who had published books for the 844 system for a long duration of time. Yeah? And then suddenly, the government changes this system, the education system, from 844 to CBC. Where will these guys send these books from? Or the syllabus changes. Where will they take the books from? The books to? Political risk. Another risk that you have is horizon risk. What is horizon risk? The risk that your horizon, your investment horizon is cut short. You are employed and you have taken up a mortgage, and then suddenly you lose your job. What are the chances that you'll still be able to pay this mortgage? Remember, your source of payment has been cut short. Your horizon has been shortened. So we also have horizon risk. How far do you expect your asset to serve you or to benefit you? And what are the chances that it can be cut short? When you invest in a property, we have seen property coming down and collapsing. When you invest, a property is expected to serve you for that long horizon, right? And then 5 years down the line, from when you invested in this property, terrorists come and blow it up, or it's affected by terrorists. Your property is out. Unfortunately, you had not insured it against terrorism. The horizon of your investment would have been cut short, right? You have invested in a property, and unfortunately, due to structural defects, it is cut short. The property crumbles down or cracks and crumbles down in a manner that it cannot be repaired. What are the chances? Will you still have the value of your property? Certainly not. Your horizon would have been cut short. You have invested in a circle, and your circle goes into receivership. At the point when you're saving in your circle, you knew or you had a mindset that 10 years down the line, 20 years down the line, you'll access the funds you have accumulated and use it to invest in a specific asset or start a business. And then your circle is put in receivership, like we saw in the Metropolitan Circle. Your horizon will have been cut short. So we also have horizon risk, right? Things that you need to be aware of and learn how to mitigate. Another risk that we have is capital risk. What is capital risk? The risk of you losing your capital. You have bought a property. Unfortunately, it's a fraudulent property. And you lose. You realize you are sold for hot air. Someone had gone into the lands registry and you've been sold for a fraudulent title. You've been given a fraudulent title. Or you acquired a property in a road reserve in public land, and the government comes and repossesses that property. Will you get back your money? Certainly not. So you'll have lost your capital in that investment in your land. You have bought shares. You buy shares at a point when Safaricom shares is at 40 shillings. And then at the point when you want to sell it, the shares is at 15 shillings. You'll have lost your capital. 25 shillings capital loss. So capital risk is the risk of you losing your capital in an investment. Even when you're a business person and you've bought your watermelons, you're coming to sell them, you're not able to sell, and they go bad, will you still have your capital? Certainly not. You'll have lost your capital. So capital risk is the risk of you losing all of your initial investment or a portion of your initial investment. Your initial investment being your capital. We have legal risk. This is the risk of you having legal issues, for lack of a better word. The risk of laws being changed such that you are predisposed to lose your asset. Last but not least, we have concentration risk. The risk of you having, the risk that you predispose yourself to when you have your investments concentrated in one asset class. For instance, you are investing in shares, you have stocks, and you own the companies in which you have invested in. I mean, the companies whose shares you have bought is in one, it's concentrated in one industry. For instance, you bought stocks for banks, and remember these rumors that was out that the banking industry is about to collapse. If this happened in a different economy, by the way, the share prices for the banking sector would have dipped. So if you had your assets in that specific industry, concentrated in one specific industry, it is possible for you to lose value when that industry is affected. Finally, please leave me a comment in the comment section. Let me know which other investment risk there are or we are likely to experience and I have forgotten to mention. Leave me a comment in the comment section. Also, let me know which assets or investments will predispose you to these different risks that I have mentioned. Do subscribe to the channel, give me a thumbs up, and let's meet on the next video.